From New York City for our viewers worldwide, I'm Sonali, Basak, and Bloomberg Real Yield starts right now. And coming up, the U.S. jobs report offers investors some relief as payrolls moderate, yields spike higher. The data pushing back Fed rate cut bets even as President Trump pushes Powell for a full point cut. And as Congress continues budget talks, Jamie Dimon and others warn of potential cracks in the bond market. But we begin with the big issue: job growth moderates in May.
Way is slowing, but still a strong labor market.
Yeah, an economy that's doing okay because the service economy is just doing all right.
The economy is going to be largely okay.
The data, I think the jobs data will get a little bit worse going forward.
But I think that hard data is going to start to soften.
That's what the Fed is going to be looking at.
At the end of the day, what they're focused on for cutting rates is really the employment picture.
The Fed's in a good spot here to wait and see. Will they be lagged? Yes.
The Fed is really on hold. I mean, it's really hard to see them do anything through the end of the year.
So, if you're the Fed, you're just sitting on your hands for a while.
The Fed doesn't have as much control of the long end as they've had.
Well, the bond market kind of captures everything.
I think the bond market is pricing in stagflation.
Yields will go lower as sort of growth slows down.
There are going to be some significant challenges to the bond market. The uncertainty is likely to fade to some extent.
Really, it comes down to not what do we think about the uncertainty, but what do we do about the uncertainty?
And if you have a Bloomberg terminal, you can look at function WIRP on your terminal, and you can see just how uncertain some of the market pricing looks. These are Fed funds futures that show you that September 1st rate cut is in flux. It has been changing throughout the week in terms of what investors expect. And right now, there is not as much of a chance as there was earlier this week. But by December, there is an expectation that we'll have at least one, maybe two, but currently the market is still pricing in less than one. Realistically, though, the market is not expecting 1 full percentage point worth of rate cuts until the end of next year. Let's pull up the screen here because we did hear from President Trump this morning. He is pressuring the Fed chair to do more, posting on Truth Social here that too late at the Fed is a disaster. Europe has had 10 rate cuts. I will point out they've had 8, but let alone, he says, we have had none. Despite him, our country is doing great. Go for a full point, rocket fuel. Now, here's the problem. Even if the Fed were to cut rates, we're hearing from one investor after another more worried actually about the long term. The longer bonds are very much in focus in the middle of this tax bill. Apollo President Jim Zelter spoke with our own Kriti Gupta, and he said that the potential U.S. spending plan under discussion has awoken the bond vigilantes.
The so-called bond vigilantes have woken up those to the concern about the growing deficit in the United States. So in the marketplace right now, with a little bit slower growth and some concern, a lot of hand-wringing, the deficit issue is taking the main stage versus the impact of the tariffs.
Let's talk through it all with Herr. She is U.S. CIO of Global Fixed Income, Currency and Commodities at JPMorgan Asset Management. And Stephanie Larosiliere, she is Head of Fixed Income Business Strategy and Development at Invesco. You know, Kay, you looked at the president's wants, this idea of a full percentage point cut. The market does not have that priced in until the end of next year. What is the market seeing that the president is not?
Well, the market does have it priced in. I think the president is just calling for it now, and the market's saying that that's premature. If we take a step back and look at what the job market has shown this morning, I think that's going to agree with what the market's saying. So while job growth, as you said, moderating, absolutely right. We had 138,000 new jobs created, a little bit hotter than consensus, but revisions over the last couple of months are 95,000 fewer. I think it's really important to remember we still have unemployment at 4.2%. We still have average hourly earnings growth of 0.4%. Job growth is moderating. So 2025, it was running north of 171,000 jobs. Now we're back down to 124,000 jobs. So that's moderating, but that's more consistent with economic growth, more along the lines of 1.5%. And it's a little bit dangerous to throw rocket fuel on it at this point, I would say.
Yeah, speaking of that too, the jobs numbers certainly were not only surprising. You saw the movement in the 2-year yield not only edge higher after the release, you are still seeing them move higher. We are well above 4% on the 2-year. We're 11 basis points higher on the day. Stephanie, when you looked at the jobs numbers this morning, how convinced are you that they'll hold?
So, as we were just listening to, what our view at this point in time is that we've got to take it with a grain of salt, right? We've seen a lot of revisions of the data. We've seen a lot of data actually come in the revisions much softer than we expected. Now, I think, a lot of the rhetoric, a lot of the, the speak that we hear out of Washington has people expecting the absolute worst. So we had consensus expecting a much lower number. So we surprised to the upside. But I'm not necessarily sure at this point that this is where we're going to stick. We do believe that there is potential to see a slight revision to the downside here as well. So that's something we're paying attention to.
Yeah, how much are you watching the weakening of the broader economy? When you look at the push-pull, I want to even just point out this week, you looked at manufacturing and there was a little bit of concern there. There's an idea here that services will hold up the economy, but will it?
Yeah, so look, the bond vigilantes obsess about every single data point. And I think Stephanie makes a terrific point that there's a lot of noise, there's a lot of revisions to numbers. The margin of error on a job number like today is plus or minus 100,000 jobs. So I think people need to take a step back, look at the totality of the data. We'll have more economic data next week in terms of inflation. But I think the totality of that in aggregate is showing an overall U.S. economy that is slowing, that growth is moderating, and that's a good thing. You look at the last 100 years, as David Kelly would say, economic growth at 2%, we're softening to a 1.5% number. I think that suggests that the Fed has achieved their outcome. They obviously are still restrictive, but they've been very clear. They're waiting for data to substantiate that we're seeing significant weakness, and the data hasn't corroborated that yet.
Yeah, speaking of the short term versus the long term here, I want to pull out a quote from the big boss over at JPMorgan, Jamie Dimon. He said that I just don't know if it's going to be a crisis in 6 months or 6 years. I'm hoping that we can change both the trajectory of the debt and the ability of market makers to make markets. Unfortunately, it may be that we need that to wake us up. Now, Kay, you look at the, Stephanie, look at the market. You do see, of course, fluctuation here in the longer term bond market, but we're not screaming at alarming levels. We're not seeing that crack that Jamie Dimon is talking about. What would it take to get us there?
I think at this point, companies are still in good shape. So we're looking at U.S. investment grade companies and where they are. And we haven't seen, any cracks in the facade as it relates to balance sheets. We're not seeing defaults pick up. Those are some of the things that we'd be paying attention to. We have seen a slowdown in hiring, but we also have seen much less firing. So people are, keeping people on board. But the uncertainty, the volatility has really made U.S. companies more cautious. And I think until we start to see cracks in that facade, I think we're in a pretty decent space, and I probably call this, somewhat of a Goldilocks situation that we find ourselves in right now.
Yeah, Kay, when Jamie Dimon is talking about cracks in the bond market, you were kind of describing to me the bench, the big bond bench over at JPMorgan. What do you do? What do you and your colleagues say, and what does it force you to have to look out for even more, perhaps?
We were talking about the bench, so yes, when you said big boss, I thought you meant my boss, Bob Michael, who's a regular here, but I see what you mean there. So I think it's really important to not get caught up in all of the noise around every single economic data point. You take a step back, the Bloomberg Barclays Ag is yielding 475. You put a spread on that, you can get attractive yields in bonds. And we are focused on delivering what our clients want in bond portfolios, which is ballast against potential declines in stock markets, yield advantage. And as Stephanie articulated well, you can absolutely achieve that. You see strength in corporate and consumers.
So, Stephanie, give me a sense of demand for the 10-year. Let's go out longer on the curve, maybe not very long, but long enough to pay attention to that nearly 4.5% yield that 10-year is offering. Is there still too much risk there, or are you seeing people looking to significantly bite?
We are starting to see, some significant appetite there. I think, when we look at even credit markets and we look further out in the curve, the technicals are still really good. We continue to see demand for U.S. Treasuries, for U.S. credit. And until we start to see those cracks start to creep up and we start to see perhaps some weakness in the dollar, which we are expecting here, we still believe U.S. Treasuries and U.S. credit assets will continue to be in high demand, going forward for the near term. Second half of the year, I think, is where we're paying attention to. I guess we're almost there, weeks away now, but that's when we are going to be looking for a little bit more slowdown and a little bit more weakness in the dollar, which could shift that demand.
A lot of people talking about the Section 899 provision. Over at JPMorgan, Kay, how much is this a real question for the markets? This is the so-called revenge tax that is in the tax bill. This idea that it could make life very difficult for foreign buyers, unclear really about what that ultimate bill will look like and what it means for buyers of U.S. Treasuries.
Yeah, before I touch on that, may I go back to a point Stephanie made, which was a very good one? We're seeing almost record demand and issuance. You've seen very strong issuance in the muni bond market, in the corporate IG market, and also the high yield market has had strong issuance. And we've seen at JPMorgan, I think it's a record $24 billion of flows into active ETFs, which is really pretty incredible. On whether it's Section 899 or any of the other, there's an extraordinary amount of uncertainty, and that's why you see strong volatile moves in the bond markets on a day like today. There's concerns about the big, beautiful bill. There's concerns about what is going to be in it. In Section 899, it looks like Treasury interest would be exempt, so that will not be a dominant factor and will not affect the long run. But I think there's just so much uncertainty about what that bill will contain. That's why you get the volatile moves like you're seeing in the bond market.
Favorite trade, Kay, right now?
Favorite trade? I think we've been moving up in quality, but we like corporates. We like securitized. We think there's a lot of value, and as Stephanie noted, there's a lot of strength in the corporate health and also in consumer health. Jobs are still strong, and that leads to spending.
Stephanie, favorite trade?
Yeah, at this point, we like the diversity in the globe, right? So we're not necessarily in a space where we're advocating to be just in the U.S. We're looking at global markets. Collectively, we think, U.S. assets still have very much value to be added to a portfolio, but we do believe that it's time to start to look to diversify. So we really like that global fixed income space. We have a strategy, Global Strategic Income, doing amazing, top decile in the 1 year, and that's really where we're finding a lot of value, and that's what we think folks should be looking for going forward.
Absolutely. The global rate differential is becoming a massive, massive story in this market. We got to leave it there. Happy Friday to both of you. That is Kay, Herr of JPMorgan Asset Management and Stephanie Larosiliere of Invesco. And up next, we're going to talk about the auction block because U.S. high-grade bond funds see their biggest weekly inflow this year as investors rush to lock in those high yields. We're going to talk credit next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we're going to focus in on credit, and we're going to start with the main highlights from issuance this week, starting with U.S. high grade. John Deere, Delta, Motorola, and Bank of New York Mellon, all part of this week's sales. Weekly volume coming in at around $26 billion, slightly below projections of around $30 billion. And looking at U.S. high yield, it is off to a hot start this month. Volume was more than $13 billion, making it the busiest week for sales in more than a year. June already tops the total we saw for all of April. And Elon Musk was certainly in the headlines this week, and that includes the debt market. He is selling $5 billion in debt for his AI startup XAI, and TPG is said to be an anchor investor in a loan that is part of the offering, which Morgan Stanley, clearly a preferred bank these days, started pre-marketing in recent weeks. The proceeds from the debt will go toward general corporate purposes with commitments due June 17th. Certainly was watching that deal closely this week. Despite this hot start for June issuance, Winnie Caesar from CreditSight says she's still kind of concerned. Take a listen.
We are seeing a pretty significant uptick in uncertainty, and we're at a little bit of an inflection point in terms of fundamentals. If we start to see some softening in growth expectations and top line revenue, while at the same time costs are just not coming down at a similar level, that can be really challenging from a profit margin perspective. And we also think will probably weigh on spreads.
We're going to now bring in Patrice Altongy, head of debt capital markets at HSBC Americas, and Michael Best, high yield portfolio managers at Barings. Two of the perfect people to talk about risk appetite right now. Stunning amount of activity in June already. If you thought we would see this a couple months ago, you would have made different decisions probably as an investor, wouldn't you? Patrice, what are you seeing from issuers right now who are looking to tap the market? Is there going to be enough supply this summer to really meet all the demand that's out there?
Well, you're making a great point. The demand is high. And when we talk to issuers, we are telling them to look now. With regard to everything going on with tariffs, we have a bit of reprieve in the markets, and issuers are coming in full force, both in dollars and euros. We're seeing volumes there in both markets up significantly. U.S. issuers are not only accessing the dollar market, but we're also seeing U.S. issuers head over to euros as well. They offer really attractive coupons, sometimes, in between 150 to 200 basis points inside of where they can otherwise fund in dollars. And if you have operations over in euros, you can be looking there too as sort of a net investment hedge in your business. So everyone's looking now. There has been some pull forward, but to your point earlier, it has been met with just incredible demand.
It's interesting because given the volatility we had this week, at least on the headline level, we didn't see it actually at the index level. We saw it in terms of the tit for tat with the tariff discussions. Michael, what does that mean for how you invest in riskier assets right now? Do you feel like the worst of the policy-making uncertainty is over and it's time to dive in? Or do you think that there's still too much tail risk to take on that significant risk?
Yeah, I think the riskier parts of the tail risk structures that are out there are still a little bit risky for us right now in this kind of market. The tariff headlines obviously being very topical, but also the U.S. consumer and their ability to sort of weather these tariff increases, I think, is a big concern for us. So we're sort of sticking to the core of single B, double B rated credit right now. I think there are a couple of things here and there in triple Cs, but as you can tell, just looking at index data or anything of that nature, triple Cs have really lagged the rally, both in the leveraged loan market and in the high yield bond market right now. So a little bit cautious on some of those things, but yeah.
It's interesting. One reason I'm hearing from some banks is that a lot of issuers are pulling forward their issuance to right now because things are calm enough to get things out the door. How much are you seeing that happen, Patrice? And is it a good or bad thing? You could say that maybe in the second half people will pull things forward again, or you could say this has to get done now because it can't get done tomorrow.
Yeah, I do think there is probably some pull forward, although when we were in April, people were at a little bit of a pause, seeing that there was some rate volatility. And certainly investors in the investment grade markets like to see stability in those rate markets first before they're going in. Technicals are strong. When we look at the investor side and what investors are thinking, spreads aren't so compelling for them in every instance because we're back from April. It has been a buy-side opportunity for investors. When spreads widened, investors went in hard. And a lot of the inventory on dealers across the street went very low as investors put money into the secondary markets, which means now they're heading into the primary markets. That means tighter spreads for them. And so some of them are being quite selective. However, the opportunity to buy out the curve, and if you're a total rate of return investor, you are looking at a very, very attractive market. And what we're seeing in conjunction with that is credit curves really flattening as you go out the curve from 10s to 30s and 30s to 40s.
Michael, when you look at kind of peak areas of concern, where are you most concerned and how do you feel the story could play out?
Yeah, I think there's a couple of spots of concern. I think one of the spots of concern is just the retail consumer products, consumer discretionary sector, right? You have a cohort of wealthy individuals who are very much able to weather, with their sort of wealth effect, able to weather the storm. But there's a lot of credits and opportunities that exist sort of in that middle income cohort where we just see a lot of stress on their both, every single payment they've got to make on housing and student loans and things of that nature. So we think that's the largest spot. And then I think the second largest spot is just idiosyncratic credit risk that exists out there. Media, tech, telecom has lots of that. It's hard to paint it with a very broad brush, but Obviously, when it goes bad, they can go bad in a hurry.
You know, I want to point out, Patrice, we had a really interesting conversation back in February of this year where you had pointed out something I hadn't realized, that the interest rate on Treasuries account for 60 to 70% of the coupons for companies issuing debt, which means that this higher 10-year, people don't really realize what the ripple effects in markets are. You back then had a worry that a lot of people still have today, that 10-year going much higher, even as high as 5%. What kind of issue is it creating that longer-term financing costs remain this high?
Yes. Well, we've started to see that steepening between the 10s and 30s part of the rate curve. And so when we look at that and you think about going out the curve, that percentage of a coupon that the Treasury component is taking is higher and higher. So we will see the credit curves adjust to that. And so that's the impact that we've seen right now, is some of that flattening. The demand from investors for long-dated paper, though, is very, very high. We really don't see bad parts of the credit curve for issuers looking out the curve, but we do see investors pivoting a bit to prefer and over-index towards the long end, actually, because they can get those all-in yields. And we're actually seeing a lot of corporate cash come back into the front end of the curve. And when I say front end, I'm really thinking about, 3 years and in. Definitely seeing that buying interest coming from corporates back, which we hadn't seen for a while.
Fascinating, that short-term flock to safety. We have to leave it there. We thank both of you so much. Happy Friday, of course, to Patrice Altongy of HSBC and Michael Best of Barings. We're getting a little bit of a buy-side, sell-side vibe today on this Real Yield. But still ahead, we have the final spread because we still have ahead of us a big week ahead. Apple's developer conference, bond auctions, and the big one, U.S. CPI data. Stick with us. This is Real Yield. I'm Sonali, Basak, and this is Bloomberg Real Yield, and it's time now for the final spread, the week ahead. Coming up Monday, Apple's Worldwide Developer Conference. We're going to get inflation and trade data out of China as well. And Tuesday, I'm going to be in Hong Kong at Bloomberg Invest, speaking with investors, deal makers, and economists. Plus, SpaceX plans to launch a crewed mission to the International Space Station. We'll be watching that closely, given what's going on with Musk and the president. Wednesday, U.S. CPI comes out. Plus, very exciting, Double Line's Jeffrey Gundlach will speak at the Bloomberg Global Credit Forum. We'll be watching that. There's a huge lineup that we're expecting. Thursday, more economic data, PPI and jobless claims, also a highly anticipated 30-year Treasury auction. Friday, University of Michigan consumer sentiment data, inflation data in Europe, and we're going to look ahead to the 24-hour Le Mans race in France, where our own Matt Miller will be. For my final thought, we're going to look at the CPI data expected on Wednesday. Core expected to tick up to 0.3% in the month of May, highlighting concerns over impact from tariffs. But we'll keep an eye on it. From New York, that does it from us. Same time, same place next week. This is Bloomberg Real Yield.